It's Quant Trade Edge, and today I wanted to just reinforce the logical trader framework on the S&P 500. So today, this is a pit session chart, and we had a pretty large gap down, 61.49 to 27, about 22-point gap down. And remember, with this logical framework with this logical trader framework, we take the first 20-minute range, and that is this yellow box. And then we're looking at 3.5 points above and 3.5 points below, and we're trying to see if the market goes and establishes itself above this level, which is called A up, or this level, which would be called A down. And the market moves in price, but also in time. So with an opening range of 20 minutes, you would want to see it stay above or below for 10 continuous minutes. And I take it to mean entirely above or entirely below. And that would give you more indication that the trend is set in that direction. So this is 850. We tested above, not even up to A level. Then we went all the way down here by about 9:15, and you can see how we spent some time here, but we didn't really do any damage because we didn't set 10 consecutive minutes beneath. In fact, we didn't get a single minute that was entirely below the A level. They all had little tails above or parts of the body above. So to me, this thing is meant to scare you out. It happened quickly. It went down right here, but not a single minute even closed completely under that A level. And then what do? We rallied straight up to the A level on the upside, which is 61.3650 on the March contract, because this 20-minute range topped out at 61.33. And again here, there's 1, 2, 3, 4, 5, 6, 7 minutes in that range. None of them are completely above. And then we came down and tried it again. And you have 1, 2, 3, 4, 5, 6, 7. And then you have 1 minute that's above. 8, 9, 10, 11, 12, 13, 14, 15. You had 3 minutes above and 1 minute above. But that's not enough. And then we came off again. And then we tried it one more time and couldn't even get to A level. Stopped a tick shy of A level. And then the slow drift down, and very late in the day. And A is not so useful late in the day, but technically we did get an A down very late in the day. This would have been the first one that was completely inside at 218. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 minutes. 12 minutes below, and then you had this tail that went up above, and then you had 1, 2, 3, 4, 5 minutes below again before we went back into the opening range. So, using this framework, this could have let you know down here that, okay, this isn't a gap and go that's going to keep going all day. When you came back up here, this could have let you know, okay, well, it's not like we've repaired everything and we're heading back to gap fill because we couldn't get 10 minutes above. Might have been a little tricky in the afternoon down here. I was personally watching for some big support at 61.07, and we didn't even get there. So, so I wasn't really ready to short here, when there's only 5 more points down to what I thought was some significant support. And then we just got back into the opening range. So, this is how you can use this as a framework. And for me, I don't even trade the ES all that much. I'm using this to cue my risk on stock options, on options of leading stocks. So, now I'll share one more concept here. If you make an A down and then you head back up, and you would make what's called a C up. So once you have in one direction you have the A, then the C is the opposite side. And what that means, if you get a C, is that people are trapped. Because let's say this was earlier in the day, and let's say we had our A down, that would mean that people decided, okay, this is bearish, the trend is down for the day. And then if this were to come back into range and then go to A up, and from what I remember, the A up level is half a point above the opening range. So if the opening range was 33, the A up would be 33 and a half. And we didn't quite get there. But if we had gotten, 10 minutes above this, and sometimes, when you start getting above this, it starts to get urgent. It doesn't necessarily give you 10 nice bars here and give you time to get in. You might have to front run it sometimes. But the reason this becomes urgent is because you've now trapped people. If the majority of people follow this framework, this framework was made for floor traders, and that's a lot of what floor traders did. They figured out what was the direction of the day, and then they went with it, and they kept scalping in that direction for the day. So if all of your floor traders are short, and then you quickly get back above the opening range, you've trapped them, and that's what can cause some fuel to the upside. And that didn't happen today. I'm just pointing it out because it was close. And again, this is just another arrow in your quiver to help you figure out timing and direction just by watching this framework around the opening range.